Okay, thanks for your patience, everyone. So let's jump right into it since we have about 25 minutes. My name is Matt Connors. I'm a counsel at Borden, Ladner, Gervais, LLP. I work in the financial services regulation group, so specialize on anything from regulations that impact, major banks to fintechs, lending companies, money service businesses, and payments companies. So I joined about 18 months ago, and in a prior life, before that, I spent almost 8 years in Ottawa working at the Bank of Canada and the Federal Department of Finance. So I was kind of a policy wonk in this space, and now I'm on the legal side. So the goal today is to give you a rundown of 4 major areas of new law that are currently shaping the payments and lending space or will imminently have a major impact in this space. So, if you have any questions, feel free to jump in at any time. I'm going to try to keep it pretty conversational and pretty light. It's very hard to cover all of this, in a very short amount of time, so I'm really focusing on giving you the highlights here. So I'll jump right into it. First thing I want to talk about is the Retail Payment Activities Act. Very timely time to be talking about this, the RPAA. The first phase of this new law actually just came into force last Friday on November 1st. So this is a new regime in Canada that's really meant to regulate payments companies that traditionally have been unregulated in Canada. So it's not focused on, the prudentially regulated entities like banks, trust companies, insurance companies. Those are all exempt from this regime, but the focus is instead on sort of those other payments institutions that are not regulated. Maybe they're pushing the envelope, challenging the status quo. You'll see on the bottom here a few examples of the types of companies that may be captured by this, and I'll get into a little bit more detail on the next slide. But one thing that just came out in October that was a surprise to many in the industry is the regulator of this new law, the Bank of Canada, released some guidance where they took the view that some lending companies, such as buy now, pay later companies, are required to register under this new law. So I think that prior to that guidance, many believed that those types of entities would be excluded from this law, but the bank has taken a different view. So I'll talk a little bit more about that in a few minutes as well. So in a nutshell, who does the RPAA apply to? How does it work? Well, the law creates a 4-step test. It's unfortunately quite convoluted. It's difficult for me I could spend a whole hour going through this. But in a nutshell, there's these 5 payment functions that you'll see on the slide right now. If you perform one of those functions in a manner that is not incidental to another service or business activity, then you may need to register. So what do I mean by that? So let's use the first payment function as an example. So providing or maintaining a payments account. So the Bank of Canada, in its guidance, explains that, in their view, companies that store any customer information, so personal or financial information, and then use that information to facilitate some sort of electronic funds transfer would be performing this function. And so you can probably imagine there's a lot of companies that you may not traditionally view as a payments company that actually do meet that threshold because they are storing some information about their customers, and that information may indeed be used to facilitate some sort of payment. So the payment functions sort of capture a very broad net, and then the idea behind this law is the various exemptions and exclusions will narrow that scope a little bit. So as I mentioned a minute ago, if you are performing one of these functions in a manner that is incidental, then you would not be required to be regulated for that activity. And that's where things get a little bit messy and complicated because, 1, the legislation doesn't define what it means by incidental, and 2, the regulator in their guidance, while they do provide some criteria and factors to consider, it's quite subjective, and oftentimes you can sort of build a case either way for some function being incidental or for it not being incidental. And because we don't have any precedents yet, because this is a new law, we don't know, how the bank is going to fall on those sides of those subjective arguments. We can really only make our best guesses at this point. So as I mentioned, there's this incidental exclusion. There are also some clearer entity-based exclusions. So if you're a licensed bank, if you're a credit union, if you're an insurance company, then you don't really need to worry about your registration obligations under this act. So that's a bit more clear-cut, but where things get more complicated, as I said, is what I call these activities-based exclusions. So it's not that if you're a type of entity, you're exempt. It's instead, if you perform a payment function in a specific way, then it may not be in scope. So as I mentioned, last month, the Bank of Canada released case scenarios for lenders. And they have two scenarios. If you are a lender and you're not sure whether you would need to register under the RPA, I would highly recommend that you take a look at those case scenarios. They're highly detailed, so I can't get into all of the details right now, but the gist of it is, under this first scenario where there's a financing company that's only offering a loan and is not really doing any other activity that facilitates some sort of payment, then the bank does take the view that the incidental exclusion does apply. However, they then differentiate from the second company, which is a buy now, pay later business, where because the buy now, pay later company, for example, is selected as a payment method when you're purchasing the good, and because they're facilitating some sort of payment and marketing that payment service, then the bank takes a view that the incidental exclusion would not apply. So I highly encourage you to take a look if you think this may be relevant, but it likely would require some analysis. And I would emphasize that while the bank did publish these different scenarios, they haven't gone as far as to say that all buy now, pay later companies are in scope. Instead, they've just given one particular example. And you could imagine that if some of the facts were a little bit different, then maybe the result would not be the same. So what does this mean for everyone? Well, if you think that you may need to register under this law, as I mentioned, it just came into force on November 1st. Those are just the registration obligations. So there's a 15-day registration window, which runs until next Friday. That's November 15th. Candidly, this has taken over my life in the last few weeks, as many companies have been asking us to help them with this. And we're trying to get a lot of applications ready by next Friday. The good news is once you submit your application, then there's this very long transition period that runs until September 8th of next year. So the actual compliance obligations that will apply to these companies, which I didn't get into, but in short, companies that register will need to comply with operational risk management standards, cybersecurity controls, incident management controls, and if you hold any customer funds, then you need to safeguard those funds. So those obligations are all coming into force next September. So there is a little bit of runway there to prepare for that coming into force. Okay, so that's number one, things you need to be looking out for. Number two is a little bit simpler, thankfully. So anti-money laundering and anti-terrorist financing. So as some of you may know, excuse me, about a month ago, mortgage lenders, mortgage administrators, and mortgage brokers were scoped into the oversight of our AML regulator, which is FINTRAC. So as of October 11th, those types of companies are required to comply with a full suite of AML, anti-money laundering, and anti-terrorist financing compliance obligations. What I want to highlight for many of you here is that in the recent budget, the government also announced its intention to expand that scope to leasing and finance companies and also factoring companies, so companies that may offer loans to get some future receivables or some invoices, things like that. So we don't have the actual regulations yet that define what this means and define any coming into force dates. So I expect it wouldn't be until at least 2025 if it happens. But once those regulations are released, there will be a lot of work that needs to be done to prepare for that compliance. And just to give you an idea, these are the typical AML and ATF compliance obligations that apply to companies that are subject to FINTRAC's regulation. So the heart of compliance is really developing that compliance program. So that's, for example, having a policy in place that describes how you do a risk assessment, how you train your staff for anti-money laundering, and how you will fulfill all of this full slide of compliance obligations. You would need to appoint a compliance officer who's responsible for all of this. You would have to do a risk assessment. That would need to be focused on your Canadian activities. So if you're, many times we see foreign companies who have limited activities in Canada. FINTRAC doesn't like to hear that. They don't care. They want to see that you are taking Canada seriously and considering your risks within Canada, not just at a national level, but even at a provincial and municipal level. So like if you're doing a lot of work in hotspots for AML activity, like Vancouver or Toronto, they would want to see that you are considering that in your activities and in your risk assessment. Know your client, so that's KYC, typical identity verification type requirements. Many of you, even if you're not regulated by FinTrack, you may already be doing some of this. Your partner, if you're partnered with a financial institution, they may be requiring you to do that, for example. But you would need to do this in a way that FinTrack is comfortable with. So even if you do already do this, it may require you to review what you do and to make some tweaks to your practices. Transaction reporting, so you would then also have reporting obligations to FinTrack. For example, if there's a suspicious transaction or if there's a transaction that meets a certain threshold, you need to be ready to submit those reports. And then finally, I'll just mention a few new requirements, specifically sanctions evasion reporting that just came into force this summer. So if you suspect that one of your customers may be trying to evade a Canadian sanction, then that's a new type of report that you would need to submit to FinTrack. So that would be considered a suspicious transaction. Okay, and then finally, just to close the loop on AML ATF, just for everyone's awareness, because I find this stuff interesting, the FATF, which is the Financial Action Task Force, which is, I believe it's 37 or 38 international countries. Canada is one of the founding members. They are about to start a review of Canada. So it's essentially an audit of Canada's AML and ATF practices. And in recent years, especially over the last 12 to 18 months, I think, in my opinion, we've seen a major shift in FinTrack's approach to enforcement of its regulated entities. I'm sure many of you heard of some of their penalties on the big banks, for example, but there's also been a number of penalties on money service businesses, a lot of penalties on real estate brokers. So I always make the analogy, it feels a bit to me like, Canada, you're like your two teenagers whose parents are away for the weekend and you're having a party and then you find out your parents are coming home early, so you're kind of scrambling to clean up very quickly. So that's really what it feels like we're dealing with this regulator right now. I think they're really want to be prepared for this FATF review that's coming, and so they're trying to puff out their chest a bit and appear tough and show that they're very serious about enforcement of AML and ATF. So as you can imagine, that has repercussions for the industry. I think it's really not a time to not be prioritizing your compliance with these obligations. It's really important to be dedicating your resources there accordingly. Okay, so moving on to number 3, consumer-driven banking, usually known as open banking. This one will be relatively short because, the timeline on this, if any of you have been following this, it's a little bit wishy-washy and it's a bit of a gray area. So I think what I really want to highlight here is that, open banking, there is a Consumer-Driven Banking Act. It did receive royal assent this June. However, it's not really enforced yet. There's still a lot of more laws and regulations that will need to be developed in order to bring this across the finish line. If you want to draw a comparison to the RPAA, that received royal assent 3 or 4 years ago. So, I imagine that there will be quite a bit of runway here as, even though the first part of the act has come, it still takes a lot of work to actually bring that to implementing a regime. So the idea here is that consumers, with their consent, will be able to share their financial information with others to see if there's better offers, better products, better services that could be available to them. You probably are familiar with screen scraping. I did see an interesting fact recently, which I wrote here, which the government of Canada estimates that 9 million Canadians currently share their financial data and their banking login information with others. Even though that's, obviously comes with very high risk and oftentimes contravenes their user agreement with their bank. So the idea is that the open banking regime, the Consumer-Driven Banking Act, will help reduce and it could totally eliminate the need for that screen scraping because there will be a regulated way to share that information. So one thing I wanted to highlight is initially this will be focused on specific types of financial data. There is a bigger movement about beyond open banking, more so like open data. You can imagine like health data, for example. So this is narrower than that. It's really focused on the types of data that you see on the slide here. So certain types of payments information, investment products. However, there is also loan and lending type products that are included, lines of credit, mortgages, and other kinds of loans. So it's quite broad. There is a limitation that if you are a company that takes data and then you enhance it, then it kind of, because it becomes your own intellectual property, that would not be subject to the regime at first. So we often call it like a read-only type regime. However, that's just the starting point. And, there's discussion about whether that should be expanded further in the future. And then the Financial Consumer Agency of Canada, the FCAC, has been appointed as the regulator for this regime. I know that they've hired, there's a new deputy commissioner who is responsible for this, and they'll need to staff up and prepare to finalize and create and finalize those regulations and get ready to implement this. So this one is kind of a wait and see. I know a lot of people are hoping that we'll see more legislation, maybe in a few weeks in the Budget Implementation Act for the fall, but we're waiting on that. Okay, and then finally, criminal rate of interest. So the federal government published criminal interest rate regulations this June, and they're coming into effect on January 1st of 2025. So this is a pretty significant reduction in the criminal rate of interest down to an annual percentage rate of 35%. One thing I really want to highlight is even though we talk about the criminal rate of interest, it's actually broader than just an interest rate. When you consider whether you're getting up to that 35% APR threshold, you need to also include different types of fees, like if you have a convenience fee or a service fee, fines, charges, those all get calculated. So a lot of companies who don't think this applies to them, it actually could, if they have certain types of fees or penalties, they could get tripped up by this. There are a couple of important exemptions. So this law is really dedicated on consumers. So for commercial loans that are over certain thresholds, so over 500,000, totally exempt. If it's between 10,000 and 500,000 and the APR is less than 48%, then it's exempt. And also I wanted to mention that pawn loans, if they're under $1,000 and the APR is less than 48%, those are also exempt. I think the policy rationale there is, the government didn't view pawn loans as perpetuating a sort of a cycle of debt because you don't end up in collections. Instead, you just lose the good that you pawned. So it's a little bit of a different scenario from the government's perspective. And then the only thing I wanted to mention on this that's not on the slide is there were a few other related regulations that were proposed, and we're waiting for those. But one is that there would be a new advertising offense as well. So if you're even advertising at above the criminal rate of interest, then that would also be an offense. So the idea there is obviously preventing consumers entering into those types of loans before they happen. And then interestingly, and this, if you're a legal nerd like I am, it raises some interesting federal, provincial questions about jurisdiction. The government also proposed to enter the payday lending space in a limited way, which traditionally has been a provincially regulated sector. So the government proposed to limit the cost of borrowing in provinces where there are payday lending laws to $14 per $100 borrowed. And I know in some provinces, I believe Ontario and BC off the top of my head, but don't quote me on that, I believe that they currently have a $15 per $100 borrowed limit, so this would actually be a very slight reduction of that. So waiting to see if that plays out as well. So what do you need to do about criminal rate of interest? It's particularly impactful if you're involved in high-risk credit markets, obviously. If you're a non-prime lender, a non-bank lender, then you need to navigate this new restriction, this new constraint. So obviously before January 1st, if you haven't already, you want to take a look at your lending models. You want to make sure that your products and your agreements with consumers are complying with this new threshold. Okay, and that's just the very, very quick summary of 4 different areas of law that are imminently coming or just came in the last week. So if any questions, I think we have a few minutes, but thank you so much for your time. think if you have a question, you can just yell it out. But otherwise, feel free to come see me after. Sure. So the question was if I could share, some examples of fintechs that have struggled with regulatory issues. We see that all the time. So one question that we get often are companies that want to expand into Canada, and they're not familiar with being regulated because in this fintech space it's often kind of like the Wild West. So I think that's actually the first hurdle that we often see is companies. A lot of these fintechs just don't have within their arsenal the resources to comply. They're focused on growth, right? They're focused on investments. I totally get it. But then, compliance is a cost. So a lot of times they don't have those resources internal. They need to rely more on external consultants, on lawyers, of course. And that can, at some point, become no longer cost effective. At some point, it may become worth it to hire a compliance person to manage that for you, and then you can lean a little bit less on third-party consultants, but that becomes a strategic decision. I think the other thing that we've seen fintech struggling with, well, people struggle with every law, but I think the one most common would be dealing with FinTrack and the expansion of their definition of money service businesses. So I didn't get into it, but in 2022, FinTrack, as you may remember, there was that convoy and the trucker protest, and FinTrack expanded its view of which types of fintechs and paytechs are required to register as a money service business, and that's caused a lot of strife in the industry, just a lot of it because there's been a lack of clarity on who is required to be registered. So even though that happened over about 2 years ago now, there are still companies that are just being made aware of it now because their banker is saying, hey, shouldn't you be registered as an MSB? They're like, I have no idea what that is. So, that's comes up, I feel like every week that comes across our desk. So those would be the two big ones I could think of. Oh, and I guess it's outside my area of expertise, but I have to mention French language laws in Quebec. We do have a big Montreal office, and for a lot of fintechs, especially when they're thinking about entering Canada, navigating Quebec and those specific French language laws is often a major hurdle. And I see more and more recently companies that when they first come to Canada, they avoid Quebec for that reason. So that would be a third one I would highlight. Yes. That's a good question. I don't know with 100% confidence of the answer to that. I do suspect it would be included, but we would need to look at the details of the contract. I'm going to give you a very lawyer answer. We need to look at the details. Unfortunately, when it comes to determining which fees would be included in the criminal rate of interest, it's not defined clearly in statute, so we actually have to look to case law. And there is a lot of case law and court decisions that look at different types of fees. For example, storage fees. For example, like you said, like an optional fee to do something in a premium way. Like it could be faster, it could be like a better way of doing something. So there are different court cases that look at that. So it can get a little bit complicated depending on the facts. Yeah, but I would say in general, I would err on the side of if you are going to be doing the calculation and you're worried about January 1st, I would plug it in to see if that does cause an issue for you. And if it does, then I would suggest talking to a lawyer about it. If you do take that conservative approach and you're still below the threshold, then obviously you're probably fine. But I would, in the first instance, take the more conservative approach just to see where that puts you. And I think we're just at time. So thank you so much, and thanks for the great questions.